So for today's deep dive, our mission is to completely demystify the true cost of buying a home.
Right, which is something so many people get hung up on.
Oh, absolutely. And we're pulling from this stack of educational materials provided by New Home University.
Yeah, they really break down the mechanics of, home pricing, uh, builder incentives, and this specific program called the NHU Grant.
Right. And right out of the gate, I mean, they make this claim that honestly seems completely counterintuitive.
It really does.
They say the lowest priced house on the market might actually be the most expensive option for your wallet.
Which sounds crazy, right?
Yeah. So
Yeah.
to see why, I want you to imagine you're just, scrolling through real estate listings late at night. You got two tabs open.
We've all been there.
Exactly. And on the left, there is this charming, slightly older resale home, and the asking price is exactly $500,000.
Okay, 500K.
But on the right, there's a brand new construction home, never been lived in, but the price tag is $525,000.
A bit of a jump.
Right. So it's a simple question for you, the listener. Which one are you going to choose if your primary goal is to keep your costs down?
Well, it is almost a reflex to look at those two massive numbers, compare them, and immediately just declare the $500,000 house the winner.
Right. Because, I mean, basic subtraction, you'd instinctively click on the $500,000 one.
Yeah, the logic seems bulletproof.
Yeah.
You save $25,000 right off the bat, so the older home, well, it must be the frugal choice.
I would definitely think so.
But it's actually a trick question.
The trick question.
Yeah, declaring the $500,000 house the cheaper option is, it's an assumption based entirely on incomplete data.
Okay.
We actually cannot answer the question of which house costs more until we have the rest of the variables. The sticker price is really just the starting line.
So what else do we need?
Well, we need to know the interest rate, for one. We need to look at closing costs. We need to ask if there are builder incentives on the new home or, what the immediate maintenance and repair costs might be on the older one.
Oh, right, because the older one might need a new roof or something.
Exactly. And crucially, we need to factor in grant eligibility.
Okay, let's unpack this, because if we're operating under the premise that a $525,000 house can mathematically cost less than a $500,000 house, we really need to look under the hood and figure out the exact mechanisms at play.
We do. We have to move past the illusion of the price tag and look at the monthly reality.
Right.
What dictates the true cost of a house for, well, the vast majority of buyers, it isn't the price on the real estate flyer. It's the financing structure behind it.
The mortgage itself.
Yeah. So to understand this, we need to compare normal, conventional, or FHA financing to what the industry calls promotional financing.
Promotional financing.
Yeah. And the golden rule that we see emphasized throughout these New Home University sources is this price is only one number. Payment is an entirely different number.
Payment is a different number.
Yeah.
Let's try to map that onto something more everyday for people.
Sure.
It makes me think of like buying a smartphone.
Oh, okay.
Yeah. So a phone might be $1,000 up front, but if a carrier gives you a massive monthly financing credit, a deal for signing on, it's vastly cheaper day to day than, say, an $800 phone that you just bought on a high-interest credit card.
That is a perfect analogy. You are trading one metric, the initial sticker price, for a much more powerful metric, which is the ongoing cost of capital.
Exactly.
Now, pivot that logic to the housing market. What's fascinating here is how major national builders utilize this exact concept.
Like who?
Well, builders like D.R. Horton or Lennar Homes, they aren't just constructing houses, they operate massive financial ecosystems.
They're like the cell phone carriers in my analogy.
Pretty much. They often have their own affiliated mortgage lenders, and because they're building and selling at such a massive scale, they can offer promotional financing incentives.
So what does that look like in practice?
Specifically, aggressive rate buydowns to make those new homes more affordable on a monthly basis.
Okay, but let me push back on that, though.
Go ahead.
If a builder is offering a dramatically lower interest rate, they aren't a charity.
No, certainly not.
Aren't they just taking the cost of that lower rate and baking it into the $525,000 sticker price? Like, am I actually saving money, or am I just kind of financing my own discount?
That is a very sharp question. And the short answer is yes. The cost of buying down that rate is factored into the builder's profit margins on that $525,000 home.
I knew it.
But here is the mechanism of why it still benefits you, the buyer. If a builder drops the physical price of the house from $525,000 to $500,000, they destroy the comparable sales.
The con
Right, the comps for the entire neighborhood. Future buyers and appraisers will see that price drop, and it actually devalues the next 50 homes the builder is trying to sell in that same development.
so they are highly motivated to protect that $525,000 valuation.
Exactly. They would much rather keep the price at 525K and take a portion of their profit on the back end to pay the lender, to buy down your interest rate.
Oh, wow.
They purchase what are called discount points in bulk. And because of their sheer size and those affiliated lenders we talked about, they can negotiate rate reductions that a normal consumer could never get on the open market.
It makes a lot of sense.
Right. A traditional family selling their $500,000 older home, they cannot afford to drop $30,000 in cash at the closing table just to buy down your interest rate. They just don't have the margins or the scale.
Right, that changes the math entirely.
Yeah.
The builder is basically using their institutional leverage to buy you a cheaper cost of borrowing,
Yes,
which, keeps their neighborhood values up, but keeps your monthly payment down.
exactly. Now, we do need to insert an important caveat from the sources here.
Sure.
These incentives are not universal. You can't just walk into, any new build in the country and demand a promotional rate.
Right, it's not a blanket promise.
No. These are dynamic financial products. They change constantly based on the specific community, the state, the exact home in question, the closing date, the builder's available inventory, and of course, your personal credit qualifications.
So what does this all mean?
Yeah.
We're talking about rate buydowns and leverage, but talking about percentages can feel, incredibly abstract to someone who is just trying to budget for a mortgage.
It definitely can.
Let's walk through the actual math. Can you translate those percentages into real dollars for us?
Yeah, let's round it. We will take a hypothetical $500,000 loan amount to keep the comparison clean.
Okay, perfect.
So if you are buying that older resale home using a standard conventional or FHA loan, you are subject to the open market. Let's say the standard market interest rate right now is around 6.75%.
Okay, a $500,000 loan at 6.75% over a standard 30-year fixed mortgage.
Right. On that standard loan, your monthly principal and interest payment, and this is before taxes and insurance, is going to sit right around $3,243 a month.
$3,243. That is our baseline for the older, quote-unquote, cheaper $500,000 home.
Correct. Now let's look at the new construction home, where the builder is motivated to move inventory and is utilizing their affiliated lender. We're not talking about a negligible fraction of a percent here.
Right.
We routinely see promotional rates at 6.25% or 5.50.
Yeah.
In some scenarios detailed in the market data, we see 4.9 or 9, or even as low as 4.50.
Wow, okay.
Okay.
Let's use 4.99% for the math. Okay. If I take out a slightly larger loan, let's say $525,000, because of the higher sticker price, what happens to the payment?
Well, this is where the price tag illusion shatters. A $525,000 loan at a 4.99% interest rate gives you a monthly principal and interest payment of about $2,815.
Wait, so the older home with the $500,000 loan was $3,243 a month.
Yes.
The brand new home with a $525,000 loan is $2,815 a month.
Exactly.
You are taking out a larger mortgage, but your monthly payment is over $400 cheaper.
Every single month. You are saving over $5,000 a year in cash flow despite buying a more expensive house.
That's incredible.
But the mechanism goes even deeper than just the monthly cash flow. We have to look at the amortization curve.
The way the loan pays off over time, right?
Correct. Mortgages are front-loaded with interest. On that 6.75% standard loan, a massive chunk of your $3,200 payment in the first few years is just going straight to the bank as interest.
Ouch.
Yeah, you are barely chipping away at the principal. But on the 4.99% promotional loan, a significantly higher percentage of your payment goes directly toward paying down the actual house from day one.
So not only is the new home cheaper month to month, but in 5 years, you will have built significantly more equity in the $525,000 house than you would have in the $500,000 house.
Yes, exactly. It perfectly illustrates why New Home University drills this core concept into their educational materials. Do not shop by price alone.
Right.
You have to compare the total payment, the interest rate, the incentives, and the overall opportunity. The interest rate is the invisible price tag on the house, and it is almost always heavier than the visible one.
The monthly math is incredibly compelling.
Hmm.
But I have to bring us back to reality for a second here.
Okay, bring us back.
Because I feel like we are missing a massive piece of the puzzle. Saving $400 a month is amazing for long-term cash flow, sure. But what about day one?
You mean closing day?
Yeah, what about closing day? Even with a cheaper monthly payment, getting the keys to a $500,000 home requires down payments, closing costs, title fees.
Oh, absolutely.
The sheer upfront cash requirement is a massive hurdle, especially for first-time buyers.
And that is exactly the friction point that stops millions of people from ever entering the housing market.
Right.
You can solve the monthly payment puzzle all day long, but if a buyer doesn't have the liquid cash to close the deal, well, the interest rate doesn't even matter.
Yeah, you're stuck.
But this brings us to the ultimate financial tool outlined in the New Home University sources. They don't just educate buyers on how builder incentives work, they actually have a mechanism designed to tackle that specific upfront cash hurdle.
The NHU Grant.
Yes. For eligible clients, there is a program called the New Home University Grant, which can potentially provide between $1,500 to $5,000.
Wow.
Now, like any financial program, this is subject to eligibility, availability, and specific program guidelines. But its fundamental purpose is to act as a tangible financial boost for buyers navigating those upfront closing costs.
Okay, $1,500 to $5,000 is substantial when you're trying to bridge the gap on closing day.
It really is.
But we need to make a really crucial distinction here. Based on the sources, where exactly is this grant money coming from?
Good question.
Because if a builder is already paying to buy down the rate, are they also funding this grant?
It's a vital point of clarity, and the sources are explicit about this. The NHU grant is entirely separate from the builder incentives we were just discussing.
Okay.
It does not come from D.R. Horton, does not come from Lennar, and it doesn't come from the builder's affiliated lender.
So who funds it?
New Home University is an educational and advisory entity. They allocate funds from their own operational side to help eligible buyers who complete their process.
Oh, I see.
So it is a completely separate program provided directly by New Home University to assist first-time home buyers and eligible clients with those painful upfront costs.
Here's where it gets really interesting, because they are completely separate sources of funding, meaning they aren't mutually exclusive.
Exactly.
The strategy here isn't choosing between a low rate or upfront cash. The true power is in stacking these benefits.
Stacking is the defining strategy. You aren't just getting a one-off discount. You are structurally layering different financial advantages on top of one another to attack both ends of the affordability crisis.
Let's spell out exactly how this formula works for the buyer then. If I am an eligible client, I could potentially secure builder financing, which unlocks the builder incentives.
Right.
Meaning they use their corporate scale to buy down my interest rate to something like 4.99%. That solves my long-term monthly payment problem. Plus, I could potentially add the NHU grant on top of that transaction.
And that exact combination, builder financing plus builder incentives plus the NHU grant, is what the sources refer to as the NHU New Home Advantage.
The NHU New Home Advantage.
Yeah. When you combine that grant money with the builder incentives, eligible buyers are effectively solving the two biggest problems in real estate simultaneously.
Upfront cash and ongoing payments.
You're using the grant to help absorb the shock of upfront closing costs, and you are using the promotional rate to lock in a lower, sustainable monthly mortgage payment for the next 30 years.
It fundamentally reframes what it means to search for real estate.
It does.
You aren't just shopping for four walls and a roof, and you certainly aren't just shopping for a sticker price. You are shopping for a comprehensive financial package.
Yes, exactly.
Seeing those two numbers side by side at the beginning of our deep dive, the 500,000 and the 525,000, it's remarkable how misleading they are without understanding the financing mechanisms underneath them.
If we connect this to the bigger picture, it is an illusion that unfortunately costs uninformed buyers tens of thousands of dollars.
So true.
They think they are making the conservative, frugal choice by taking the lower sticker price on an older home. but they end up strapping themselves to a much heavier monthly interest burden, and they get zero help with their closing costs.
Right.
When you look at the new construction ecosystem through the lens of these stackable mechanisms, the entire value proposition shifts.
So with this mathematical proof established, how do we bring this back down to earth?
What do you mean?
Well, it is one thing to understand the theory behind rate buydowns and amortization curves, but it's another to actually model these numbers for a specific zip code, and find out what you actually qualify for.
Oh, absolutely. Well, the first step is realizing that this isn't a hyper-local, one-town-only scenario.
Okay.
New Home University operates across multiple locations and states, and they are continuing to expand. So the geographic scope of this opportunity is significant, and the builders they work with are national.
All right, so if you're listening to this and wondering how to model these numbers for your own situation, you don't actually have to build a complex spreadsheet yourself.
No, please don't.
Before you choose between new or old, and if definitely before you assume a lower sticker price means a cheaper house, you can let the team at New Home University run a side-by-side comparison for you.
They have the access, they understand the builder inventory, and they manage the NHU Grant.
Yeah.
They can sit down with you, look at your specific qualifications, and show you exactly what promotional rates and grant amounts might be available in your desired market right now. You just really need to see the total opportunity cost laid out in front of you.
And if you want to start that application process today, they have a very straightforward way to get in touch.
They do.
You can just pull out your phone right now, open a new text message, and type the words NHU Grant. Just spell it out, NHU-GRANT. Message that phrase to 301-509-7138. Again, text NHU Grant to 301-509-7138. You can also call the team directly at that number, or you can simply visit newhomeuniversity.com for all the details and start looking at how to combine grant money with builder incentives.
But as we always do with financial deep dives, we must reiterate the realities of the market.
Of course.
Mortgage rates, builder incentives, grant amounts, home prices, availability, and qualification requirements, all of these variables can and do change.
Right. It's not locked in.
Exactly. None of this is locked in stone until you are actually under contract. So everything we've discussed today regarding the math and the programs needs to be verified during your personalized consultation with the New Home University team.
The housing market moves incredibly fast, which is why getting the team to run your specific numbers is so vital. Don't guess, and don't assume the lowest price tag is the best deal. Message NHU Grant to 301-509-7138 to get started.
It brings us right back to that late-night real estate scrolling, doesn't it?
It really does.
We sit at our computers, we look at a $500,000 house and a $525,000 house, and our instincts just lie to us.
Yeah.
But it makes you wonder, if we can potentially save hundreds of dollars a month just by looking past the sticker price of a house and examining the underlying financing mechanisms, what other major financial decisions in our lives are we judging purely by the initial price tag instead of the true total opportunity cost?
That is a question that requires a lot of self-reflection. Thank you for joining us on this deep dive. Go run those numbers, and we'll catch you on the next one.